What's going on, guys? MMuniz here. Welcome back to the channel. In today's video, we're going to discuss an ETF that keeps popping up in my comments. Also, when I'm perusing Reddit, I come across it all the time, and I figured it was time to make a video on it. So we're going to talk about DGRO, or DGRO as I like to call it, which is in fact the Dividend Growth ETF from iShares. Now, more specifically, we're going to go over the fund's holdings, the strategy, the cost, how it's diversified, past performance, what we might expect in the future. And then lastly, as in all my videos, we're going to talk about if I hold it currently and what are my personal opinions on it. Now, I do need to give a quick disclaimer though. I am not a financial advisor and this video is not financial advice. It's up to you guys to do your own research and make your own decisions. The goal of this video is just to give you some background information and get you guys thinking. Maybe it's a fit for you and your family. With that said, let's get right into the video. So first things first, what exactly is DGRO? Well, DGRO is a passively managed ETF, or exchange-traded fund, that gives us access to a variety of U.S. stocks, broadly diversified across multiple industries, that focus on paying dividends. More so than that, that focus on companies that have shown sustainable dividend growth over time, actually 5 years to be exact. Now, the ETF follows an index, the Morningstar U.S. Dividend Growth Index, and there are certain requirements to be in that index, and the good news is because it's passively managed following this benchmark, the expense ratio is extremely low. We only have to pay a 0.08% expense ratio, which is only $8 per $10,000 invested on a yearly basis. It's one of the great things about passively managed ETFs. And also, some people prefer passively managed not just because of the cost, but because when things are actively managed, it allows human psychology to come into play when it comes time for the fund managers to make decisions. And that isn't always the best thing, because they might sell at the wrong time or buy at the wrong time, who knows. But let's take a look at the holdings and how this ETF is actually diversified. Now we're going to take a look at the sectors or the exposure breakdown, but before that, let me know in the comments down below if you like this setup. I used to do videos where whenever I'd bring up a page of the ETF, you wouldn't be able to see me, and now I have a camera that you can see me. So I just want to know if you prefer this or if you prefer not to see me when I'm talking about it. I just want to make the best content possible, so if you do that, thank you. But back to what's important. So as you can see, we're spread out pretty evenly amongst multiple categories. We have the highest weighting in financials, and then we have 20% in information technology, healthcare. The important thing to keep in mind is when we compare this fund to something like the S&P 500, the weightings are more diversified in this. Yes, the S&P 500 has multiple sectors as well, but 30% of the S&P 500 is tech alone. So there's a lot of focus on large cap growth, whereas this one focuses more on multiple companies. And there's a specific maximum weighting per company of no more than 3% when it comes to the actual holdings. So we're going to take a look at the holdings right now. And for its top holdings, Apple, Microsoft, tech names, as we're just talking about. However, we also have stuff like Home Depot, Coca-Cola. Now, the weight percents, we are over 3% here, but this fund is rebalanced on a quarterly basis. So once they go to rebalance, they're going to take care of that and it'll be back below the 3%. Maybe something else will take over. But we know that the holdings in this company, and we have 418 of them, all have shown dividend growth over time. Now there are other requirements to get into it, and I can show you that by looking at the index. So we need to have an indicated dividend yield that must not be in the top 10% of the universe. So they're not looking for massive yield in this fund. They're looking for the sustainable growth over time, which is good if you're going to be a long-term investor and you don't need all of the income up front. So Q yield investors, maybe this isn't the option for you, but this could still be a portion of your portfolio. Dividend must be qualified income. So, they focus on US stocks. They're not going to include REITs, real estate investment trusts, because those would not qualify as qualified dividends. We want to have that 5 years of uninterrupted annual dividend growth, and then we want to have earnings forecasts and payout ratio of less than 75%. So basically, they want to find companies that aren't maxed out on their dividend already. We need to have room to grow. So what I want to talk about now is a bit of the performance. Just keep in mind that past performance does not guarantee future results. We have about $23 billion in assets under management. We distribute dividends quarterly, and that's another way to keep down the costs as well. So some of those monthly dividend paying ETFs typically have a higher expense ratio. Now, the trailing 12-month yield is a 2.14%, which is about 0.5% more than the S&P 500. I believe I've mentioned it before, but we do have 414 holdings, and this can change in the future. Now, when we talk about strict data for the numbers, we could scroll up and we can look at our performance right here. Within the past year, we are down 3.62%. And just keep in mind that the entire market is down right now. We're currently in a bear market, in a recession, although some people will deny that. At the end of the day, everything is down, unless you're investing in inverse ETFs, which ballsy move. Our 3 years return, and this is total return, is going to be 10%, and then our 5 year is 11.3%. So overall, an 11.3% return over time is awesome, especially when we consider the tax advantages. So it has a yield, yes, and you do pay taxes on dividends, but it's a pretty low yield. It's not nothing crazy. It's not 12% like Q yield. It's not 8% like JEPI. And these are going to be tax advantaged as well. So we're looking at qualified dividends over time. When it comes time for us to sell shares of the ETF, you're going to have qualified dividends. So you're going to be in a good scenario when it comes to taxes. Now let's look at one of my favorite websites, which is the Portfolio Visualizer, and look at a back test of this compared to one of my favorite ETFs, which is VOO, V-O-O, or the ETF that tracks the S&P 500. So I did a start year of 2014 with an end year of year-to-date 2022. We're going to start with $50,000 and we are going to contribute $250 on a monthly basis. So we are dollar cost averaging through the COVID crash in 2020, through the crash currently, and we just continue investing on a monthly basis. We are reinvesting dividends when we look at total return, but you are going to see a breakdown of the actual dividends. Kind of cool thing about this website. But we're going to scroll down and we're going to go to summary, and you can see here that we have a current asset growth rate of 15%. Our $50,000 initial investment turned into $145,000 if it was DGRO, and it turned into $146,000 if it was VOO. Very, very close. When it comes to expense ratios, very close as well. We're talking about 0.03% for VOO versus 0.08%. Those are very minimal and almost free, essentially, which is awesome. Now, our best year with DGRO was only a 29% versus the 31% best year of VOO. But one thing I do want to point out is that DGRO tends to be a little bit more risk averse. There is not quite as much of a dip as the worst year in VOO. And the reason for that is I mentioned it before, the S&P 500 consists of the largest market cap companies. Part of that are growth companies, and typically those are a bit more volatile. So with volatility, you're going to have lower lows, but also higher highs. We can look at the actual chart and see that they were neck and neck for the majority. Now, up to 2020, DGRO was actually in the lead a little bit, which is pretty impressive. Here we are now where we're almost even again. We did have a big gap back in January of 2022, but overall, what we're seeing is DGRO is not going down quite as much as the S&P 500. So if you're a bit more risk averse, maybe this is an option for you. I don't know, I can't tell you that. Now, we can also go down here and we can look at our portfolio income. So this is something pretty cool. It shows us that the blue is the dividends we made in the year from DGRO versus the dividends we made in the year from VOO. Now, at the end of the day, total return is what counts. But if you want to live off primarily dividends, then this may help you retire a little bit earlier because it has a little bit higher of a dividend yield. We're looking at $1,600 versus $1,400. In 2021, we're looking at $3,000 versus $2,100. That's a significant increase. But remember, the S&P 500 just is consisted of all companies, and some of them pay out dividends, whereas DGRO focuses on dividend growth over time. So ideally, we would see this gap to continue to spread out over time. Just keep that in mind. So all in all, when it comes to this ETF, what are my personal opinions? Well, first things first, I don't hold any DGRO. But that's not because I don't think it's a good ETF. I think if you are someone that's close to retirement or looking primarily for income because you're maybe going to retire early, something along those lines, then you may need to look for something that has a bit higher of a yield. We've talked about JEPI, Q yield. Some of those are great options. If you have a long timeline until you retire, it could be a good option for you. Maybe you could replace one of those S&P 500 ETFs like VOO or SPY with DGRO. You see that the performance is very, very close. And if anything, you might have a little bit more risk aversion by holding DGRO. So if that's what you're looking for, it could be a good option for you. Personally, for me, I have a bit more risk tolerance and I have a long timeline. So I'm placing more of my faith in the volatile tech stocks. And is that the right answer? Maybe not, but we'll see, hopefully. So at the end of the day, DGRO is a low-cost ETF that has great diversification and provides a healthy yield with upside. So Definitely not any reasons not to hold it. It's just up to you guys to determine if it deserves a place in your portfolio. Now, if you guys are still watching, make sure you smash the like button down below, subscribe to the channel. We do weekly videos on anything related to personal finance or fitness. Let me know what you thought of the video. Let me know what you think of DGRO or any other better ETFs, or if you want to hear about another ETF in a video, put it down in the comments. I do my best to respond to all of the comments on all of my videos. With that said, you guys take care, and I'll see you in the next one. See ya.